Welcome to the Max Dividends channel, where we help people build growing passive income, retire early, and live off dividends. In every Academy case, we take one stock and run it through the same checklist so you can see step by step whether it really deserves a spot in a serious dividend portfolio. Today we're examining Procter Gamble, ticker PG, a global consumer staples leader whose brands sit quietly in millions of homes around the world, powering daily routines and household essentials. We'll answer, how does this company make money? Is it a good stock to hold long-term? We'll walk through the Max Dividends checklist, test its financial condition with the 5-pillar secret formula, see what role it plays in a dividend portfolio, and finally ask if PG is attractively priced today. How this company makes money. Procter & Gamble generates revenue through a diversified consumer staples model, developing, manufacturing, and marketing branded products used daily in households worldwide, sold through mass retailers, e-commerce, drugstores, and wholesale channels. The core earnings drivers are fabric and home care, laundry detergents, fabric enhancers, dishwashing liquids, and surface cleaners tied to recurring household routines with demand driven by consumption rather than economic cycles. Baby, feminine, and family care, diapers, wipes, and hygiene products with repeat purchases and strong brand loyalty. Beauty and grooming, hair care, skin care, and shaving brands where innovation and marketing scale support pricing power. Healthcare, oral care, and personal health products tied to routine, non-discretionary spending. In short, P&G operates at the center of daily consumer behavior worldwide. Exactly the kind of structure that can support a long dividend record when paired with disciplined capital allocation. Is this a good stock to buy long-term? Step 1. Dividend history. Our filter is simple: at least 15 years of consistent dividend growth. P&G clears that bar decisively. Over the past 15 years, PG's annual dividend per share has increased from roughly $2 to approximately $4.20. Step 1 passed, Procter & Gamble demonstrates the characteristics of a dividend eagle, with a multi-decade record of uninterrupted increases that reinforces its position as a long-term income compounder. Step 2. 5-pillar secret formula. First pillar, sales growth, the foundation. Over the past decade, Procter & Gamble's revenue increased from roughly $65 billion to approximately $84 billion. That trajectory reflects the strength of P&G's focused brand portfolio and global scale, rather than reliance on a single geography or a short-term surge in demand. Growth has been supported by consistent product innovation, pricing power, productivity improvements, and disciplined portfolio management, all playing out despite currency headwinds and shifting retail dynamics. Sales growth passed. P&G's steady long-term revenue expansion strengthens its case as a durable platform for continued dividend growth. Second pillar, profit growth, the fuel. Over the past decade, net profit increased from roughly $32 billion to more than $42 billion, reflecting a business that has become more efficient while maintaining healthy margins across cycles. This is supported by category-leading brands with meaningful pricing power, deep marketing capabilities, and a streamlined portfolio focused on higher-margin segments. Profit growth passed. The expanding earnings base reinforces the durability of the dividend. Third pillar, net income, true strength. Net income has generally trended upward into the mid-teens billions of dollars over the past decade, with only modest year-to-year fluctuations along the way. That resilience is rooted in the nature of P&G's business. Everyday essentials like laundry, hygiene, grooming, and oral care that stay in demand regardless of the broader economic backdrop. Net income passed, a decade-long pattern of sustained profitability and overall growth. Fourth pillar, dividend payout safety, protecting passive income. Over the past decade, the payout ratio has generally fluctuated between roughly 55% and 75%, with occasional spikes driven by temporary earnings pressure rather than structural deterioration. P&G continues to invest in brand support and innovation while still returning a significant share of profits to shareholders. Dividend payout safety. Pay attention, the payout ratio exceeded our preferred threshold in at least 1 year over the past decade. This looks like an isolated occurrence rather than a persistent trend, but it's a detail worth watching rather than a clean pass. Fifth pillar, debt burden, avoiding traps. The debt ratio has generally moved within a fairly narrow band, from the mid 0.50 to low 0.60 lows over the past decade, a moderate level that's not unusual for a defensive consumer staples business with substantial predictable cash flow. There's no sign of aggressive debt expansion. Debt burden passed. Leverage appears measured and well managed. Procter Gamble's overall financial score comes in at 90. Very safe in our framework, reflecting strong financial stability and consistent cash flow generation. Does it fit our plan? MaxRatio combines current dividend yield, dividend growth, and financial strength to classify stocks as growth eagles, balanced eagles, or income eagles. PG's MaxRatio is 4.65, placing it just inside the balanced eagles category. With a dividend yield of 2.98%, PG offers a solid current income stream, while a multi-decade record of increases demonstrates management's exceptional long-term commitment. This blend of steady income and dependable growth is supported by category-leading brands and recurring non-discretionary demand. Is the stock undervalued today? Versus peers, PG currently screens as undervalued in the Max Dividends research platform. Versus its own history, PG has traded at an average PE of approximately 27.6 over the past decade, partly inflated by one unusually high period. Today, the stock trades near 21.5 times earnings, below its long-term average. On yield, PG's dividend yield of 2.98% sits above its 15-year average of around 2.78%. Investors are currently receiving more income than they typically have. Analyst consensus sees modest short-term upside for PG, with price targets skewing toward a buy-leaning average view. Final decision. Procter & Gamble occupies a rare position at the center of everyday consumer life, supplying products households buy repeatedly regardless of the economic cycle. It fits naturally within a Max Dividend-style portfolio, a durable franchise built on brand strength and recurring demand, rather than a speculative growth story. PG screens as undervalued relative to peers and trades below its own long-term valuation average, while its yield of 2.98% sits above its historical norm. The one item worth flagging is payout safety, a ratio that's crept above our preferred comfort zone in at least 1 year, so it's worth keeping an eye on rather than assuming it's fully locked in. Taken together, PG remains a compelling long-term holding for income and growth portfolios. Subscribe for more analysis. This is not investment advice.